Fed minutes coming out earlier today, and they're showing that a third round of quantitative easing might just be around the corner. Members of the Federal Reserve inch closer to pushing the button on a new round of bond purchases. We'll be asking our next guest, Greg Weldon, his thoughts on the Fed and, of course, the gold market. All this coming up on The Spot. So back by popular demand, Greg Weldon joins me from his home in New Jersey. Greg, thanks so much for being with us.
Oh, it's my pleasure. Anytime.
So Greg, just to start off, last time we spoke, you were bearish on the gold market. Has your focus changed at all now?
Our view has evolved to some degree, yes. We had believed that there was a good chance that the 15 and a quarter low could be tested, if not violated, because basically central banks are absent from the debt markets right now. They're not monetizing debt. There's no currency that's being debased. So this removes a major bullish factor from behind the gold market. So we anticipated since the Fed and maybe even to a lesser degree the ECB are really kind of boxed in here on a time frame basis with the election in the U.S., that might lead to pressure. What's interesting is that those levels have held. If you look at a candlestick chart, for example, you see tails on the charts between 15.75 and 15 and a quarter. And what we mean by that is days when the gold price was down significantly, where it didn't stay down even for the bounce of the day, closed strong. You had a lot of reversals from those positions. We theorized, this could be a scene where central banks could be buying gold simply because they don't want it to break down because of what kind of a signal that might send to the equity markets and really would expose the macro dynamic globally as being as weak as it really is. In fact, you get the World Gold Council data just recently released shows second quarter official accumulation of gold, the largest single quarter buying ever by central banks. So you can see it on the charts. It's there. So they may not be, monetizing debt right here as a support for gold, but they are buying gold. And whether that be, diversification of reserves, which is a big part of it with someone like Russia, or whether it's actual, officialdom under the table buying, you've seen accumulation of gold by official monetary authorities below 1575.
Greg, are there any surprise buyers for you in that mix?
No, because they were the buyers that we thought we were seeing. We've heard more recently some of the bigger speculators have come back into the market. You don't see it yet in the CFTC data, but really yesterday's price action was key because it was a technical breakout. You took out Fibonacci levels. You took out the 100 and the 200-day exponential moving averages. You took out the shelf of recent highs around 1630. Technically, a significant day, but that remains to be seen whether we can build on that trend or not.
So we're seeing these sporadic breakouts, Greg. What's weighing on it? Is it really the outside markets, the U.S. dollar index, crude oil?
Well, I think everything's linked to the Fed. Bottom line, Fed, ECB, markets in the equity sphere for sure. And now I think this has spread to commodities because you can see this is kind of a broader breakout than just gold. The CRB broke out yesterday as well, and the dollar broke down, at least on preliminary technical basis. So really, the markets are riding the wings of hope. The hope that the Fed and the ECB are going to step up, potentially in a concerted effort to deliver a monetary miracle. Now, that needs to be seen, whether that reality, meshes with the hope for outcome that markets are basically being driven upon right now.
Greg, so Jackson Hole meeting coming up next week. Bernanke will speak. How much importance are you placing on that meeting?
Not too much importance on that. I just don't think they're going to act here. I think the fiscal future of the U.S. hangs in the balance of the election. I don't get political, but this is a huge election in terms of determining the future fiscal path that we're going to go under. That's huge information for the Fed. They're going to want to see that. They're going to want to know that. They're going to want clarity on that. Having said that, you have room in the bond market here for a little bit of a rise in interest rates before it becomes problematic in terms of probably how the Fed views it. So it would be interesting to see how that plays out if you, in fact, get a rise in bond yields here because the Fed is kind of hemmed in and can't do anything, and how that might actually drive some of this huge liquidity that's been stored in bonds back into equities and maybe even commodities. I think there's a hint of that going on right now, and it'll be interesting to see how that plays out, and then leads into the Fed having an excuse, i.e. higher bond yields, with huge treasury supply coming in the latter part of this year, by the way, enormous, almost 1.7 trillion in treasury debt maturing. Without the Fed as a buyer there by the middle of November, be hard to see how that doesn't cause a bigger rise in interest rates that becomes problematic. The Fed will be there ultimately because they know they have to be.
Greg, you mentioned a monetary miracle. what would the Fed need to do? What needs to be done here?
Well, that's a great question. I mean, it really is. This is probably the biggest question of all. The timing is a little uncertain, but I don't think the end game that they will do something, lacks certainty. What lacks certainty is how aggressive and what means do they take. The problem here is really the macroeconomic dynamic continues to deteriorate everywhere. And this is a function not only of Europe, but also of the U.S. Labor market remains chronically ill. I mean, I don't care what the headlines show you, population growth outdoes, payroll growth in the U.S. That's not healthy. Chronically, millions of people long-term unemployed in the U.S., not changing anytime soon. It's going to be difficult for the Fed with just liquidity provisions, debt monetization, and currency debasement to address the macro problems. This is great for reflating the markets. Part of the reason it does reflate the market so well is because the money's not needed in a real economy. There's really not huge lending going on outside of some commercial and industrial lending, which in fact is linked to plant and equipment spending because they don't want to hire people. They'd rather, enhance their productivity through technology. Reason the NASDAQ is leading the way in the equity market, by the way. So it all ties together. But I think they're going to have to buy a lot of treasury bonds because you have a lot of supply coming down the pike. What is their will politically, internationally, and even publicly to buy another $1 trillion worth of bonds? That's going to be a big question mark.
Greg, Goldman Sachs recently said that the likelihood of a QE3 by year end was unlikely. What are your thoughts on that statement?
Well, I think it depends on what happens between now and year end. That's such a long time, 19 weeks to be exact, because we've mapped out all the Treasury debt that's set to mature between now and the end of the year, and it's significant. I think it's more a function of the bond market. I really do. I think it's a function of the 30-year bond, the yield curve in the U.S., the 2-year note, all of those things combined into how that plays out with the Treasury having to sell a lot of supply straight through to the end of the year. Public borrowing is up almost $270 billion over last year. That's just to fund this year's deficit. That's on top of the $1.7 trillion in treasuries we have maturing. So I think it's a function of the bond market and yields as far as the timing the Fed out beyond the election.
Greg, before I ask you to wrap it up on the gold front, let's look at silver a second here. The metal hitting a fresh 9-week high yesterday, up $1 from last week. What's happening here?
Well, obviously there's interest in silver, and for good reason in terms of kind of the long-term technical setup. Silver's had a series of 3 lower lows recently to the 2607 level, which maps out almost perfectly as a 50% Fibonacci retracement of the entire bull move going back to 2000-2001 low, all the way up to $50. It's had great support in this zone, and now you're starting to see, option volatility is low. You had cleared out the speculators. You really had a market that had, pretty much the decks had been cleared, and now you're starting to see some interest roll back. You're starting to see supplies being taken off the market too. Whether it's manipulated or not, we can debate all day long. The fact is that silver supplies being held in exchange warehouses are falling now. So that reverses a big trend that had been a problem for silver. As silver's price was declining, people were letting go their silver, inventories were building. We see the reverse of that now with low volatility, great long-term technical support. The question is, how high can it go? We're looking for 37.50 on this breakout. Yesterday was a technical breakout. For something beyond that, we need more clarity on the Fed side.
Greg, just some thoughts on the PGMs now, the platinum group metals, platinum and palladium getting a boost from, unfortunately, the violence we saw last week in South Africa. Offline, however, you were telling me that gold will really set the tone for both these metals.
We believe that's true, or I do anyway. When you look at the automobile dynamic in terms of platinum and palladium, it's been very strong, and now it isn't strong. In fact, it is now contracting. And if you look at where the strength has been, Asia, i.e. China, India, and several other places, Thailand, Taiwan, that dynamic has reversed. So it is actually now a negative for platinum and palladium. Platinum and palladium had been technically very vulnerable. They were sitting on long-term technical support. It looked like it was about to crack wide open when South Africa breaks loose. So it's definitely stemmed the decline. But for those fundamental reasons, I think that, keeping in mind that all of these commodities now are really linked back to the Fed. They move in unison. The degrees of correlation with, all asset prices are, continue to be very high. But I think given the, industrial, macro, auto dynamic that might hold platinum or palladium back relative to gold as a monetary metal.
All right, Greg, final thoughts for investors. Bring it home for us.
Oh, final thoughts, man. You got to be plugged in every day. You have to listen to your show every day, all your interviews, because you have the best people on it. And that's why I come and listen. And I feel honored to be invited to participate. But I really believe, the thing I keep coming back around, you try and short-term time these markets, very difficult, has been, trading these things, in and out is exceptionally difficult, as is looking for long-term, solutions to, preserving wealth and maybe even appreciating wealth. So, on two fronts, I think the long-term trend remains dominant. They will continue to print money when pushed to do so. That is a long-term bullish dynamic. Containment, containing $227 trillion of derivatives in U.S. bank balance sheets. That is a bullish factor longer term. Failure to contain that would be bullish for gold. The bottom line is it's a long-term bull trend that still has a long way to go. You've had a pretty big decline. You've had a period now where central banks have not been active. That's hurt the market. I think maybe you're into a turning point. If not, you have one more decline into a major turning point here where I think, there's plenty of upside to be had in these metals over the longer haul.
All right, Greg, appreciate your words. Finally, if investors would like to hear more from you, where can they go?
We're at www.weldononline.com, WELDON online.com. We do the Money Monitor, Global Macro, the Metal Monitor, which is an audiovisual product where you see, charts and we're talking about the markets. And we have, we're a CTA in the U.S. with money management services, including, a metals-only program that trades these markets specifically and is specifically designed to take advantage of this type of volatility we see now.
Greg, thanks so much. Hope to speak to you soon.
My pleasure.
And thanks so much for watching this edition of On the Spot. You can email me at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.